In this module, we'll look at HSA eligibility requirements. So as we talk about HSA eligibility, we're really speaking about the eligibility to contribute to an HSA, not own an HSA. So someone could have had HSA eligibility to contribute to an HSA, did so, has money in their HSA, for one reason or another is no longer HSA eligible, meaning can't contribute to an HSA. Doesn't mean they close their account and liquidate. They can still use the money for medical expenses. They can still invest the money to grow it going forward. Everything stays in place with the exception of being able to contribute. So when it comes to HSA eligibility, again, it's regarding being able to contribute. You can't be covered by anything but a high deductible health plan. You can't be covered by a spouse's or someone else's non-consumer directed health plan. So you can't have a situation where you have spouses, one spouse has an individual high deductible from their employer and the other has a family plan, PPO, that the other spouse is covered under. That would make the spouse with the individual high deductible ineligible to contribute to an HSA. You can't be claimed as a dependent on someone else's tax return, and you can't be covered by a spouse's or anyone else's general health flexible spending account or health reimbursement arrangement, health reimbursement account. General health flexible spending account, or HRA. We're not speaking about dependent care, flexible spending accounts, or commuter FSAs. We're talking about a general health. That would be considered another form of coverage. So you could have a situation where a husband has an individual high deductible through his employer. The wife has an individual PPO through her employer, and she elects to put $500 into a flexible spending account. That $500 in the flexible spending account, because it could be used for the spouse, makes the spouse with the high deductible health plan ineligible to contribute to an HSA. An individual becomes HSA eligible on the first day of the following month in which they meet the HSA requirements, and therefore when they lose eligibility, they remain HSA eligible for the full month, so you don't lose it mid-month. One other definition: a subscriber is the person for who the health plan is purchased, and a member is for the person who's covered under the subscriber's health care plan, if you will. That matters later on as we talk about Medicare. So again, HSA eligibility, the ability to contribute to an HSA, you cannot be covered under a general health flexible spending account or health reimbursement arrangement, health reimbursement account, whichever you want to call it. So a flexible spending account, or HRA, FSA, general health, is considered to be another form of coverage. You're not eligible to contribute to an HSA. If you're covered under TRICARE, you have coverage under TRICARE, you're not eligible to contribute to an HSA. Now, if someone has an injury from service, is going to the vets for specifically assistance with that injury, that's not considered a full form of health coverage. But if you have your health coverage through TRICARE, which is for military service members, you're ineligible to contribute to an HSA. If you're covered under any part of Medicare, even if it's Part A, which doesn't have a premium, you're ineligible to contribute to a health savings account. Now, couple of wrinkles to this. If it's a limited purpose flexible spending account, or HRA, so it can only be used for vision or dental, that is acceptable. You can continue to contribute to an HSA. If it's a post-deductible flexible spending account, or HRA, meaning the money can only be used after you've met your deductible on your health plan, that would not make you ineligible to contribute to an HSA. A retirement HRA that's available during retirement, that would not make one ineligible to contribute to an HSA. And concierge medicine, which is where an individual pays a doctor or practice an additional dollar amount for preferred service and access to that doctor or patient, is not considered to be another form of health coverage. So someone could participate in concierge medicine with a doctor or firm and still contribute to an HSA. Now, concierge medicine is not a qualified medical expense, but it wouldn't prohibit you from contributing to an HSA. Moving from a flexible spending account to a health savings account is cumbersome and clunky at best. So employees cannot participate in a general health flexible spending account and contribute to an HSA, just like we said. Most flexible spending accounts run on a calendar year and basically do not allow for mid-year changes. Okay, so here we have in the dark blue, we have an example, and this was a real life example of someone who went through the CHSA training program about a year ago. had a client who was in this exact situation and brought it to our attention. We helped them with it. National Company offers its employees a general purpose health flexible spending account as an option for the calendar year um, 2018. The company later switches all their employees mid-year from a PPO to a high deductible health plan. Well, the problem is that those employees who elected to participate in the general health flexible spending account are ineligible to contribute to the HSA until at least January 1, 2019. And the reason again is because they're covered under this, they have money in this flexible spending account, and that's for the entire plan year. So they're not going to be eligible until at the earliest, the first day of the following year. So let's take a little closer look at the movement from a flexible spending account into an HSA when it comes to eligibility. Moving from a flexible spending account to an HSA is cumbersome and clunky at best. There's some different rules with regards to the eligibility of being able to actually fund that HSA when you're moving from that flexible spending account. So looking at three different components when it comes to that flexible spending account: the grace period, that up to 2.5 months at the end of the plan year to spend unused and incur new FSA eligible expenses. On January 1st, if that person wants to move to an HSA, they're able to do that if they have a zero balance in their flexible spending account as of December 31st, or the employer amends the FSA to make it limited purpose. When it comes to a carryover, the IRS allows $550 to be able to be rolled over in a flexible spending account from 1 year to the next year. If any money is rolled over from 1 year to the next in a flexible spending account, that's going to make the individual ineligible to contribute to a health savings account in that new year. And then finally, the run-out period, that extended period of time up to 90 days to submit claims for the previous plan year for reimbursement. This is not a problem when it comes to being eligible for an HSA starting in the new plan year, because only expenses from the previous plan year are being paid during this period, unlike the grace period where you can actually incur new FSA eligible expenses during that grace period. If you still have questions with regards to this module, please email us at info@accesspointhsa.com.